What if I told you that by knowing just one simple system, you could get better results from your investments long term overall, and it won't take you a long time to learn? That's what we're going to do today on the Market Brief. Everybody wants simplicity. Everybody wants a simple system and the easiest way to learn things, because what I've found is that the simpler the system can be, the easier people can grasp it. And what we're going to cover from an investor standpoint is the simplest, easiest system that I have found in order to identify when should I be in and when should I be out of the market. And it's so easy that a 10-year-old can learn it, but sometimes things that are that easy get easily overlooked. So this is a simple system for investors, and we're going to be utilizing a moving average as a way to be in and out of the market. But it's really not just one moving average, it's a combination of two. One is going to be our on switch and one is going to be our off switch. And so let's take a look real quick at the S&P and we can see what I'm talking about specifically. Now, this system is very timely because this system uses an off switch and an on switch to tell me when I should be in the market and when I should be out of the market. But I first have to understand which moving average is acting as the on and which is acting as the off. So I'm going to start looking here at the S&P 500. So here you see a chart of the SPX. And when I look at this SPX chart on this weekly time period, we always do this utilizing weekly charts. And weekly charts are better because they allow for price to be a little slower and a little smoother. And so as I'm looking at this weekly chart, my off switch is the one I'm going to start with. And what we're going to start with is a simple moving average. Now, for those of you that are unfamiliar with a moving average is nothing more than the average closing price over the last X number of candlesticks, right? Whether it's 5 candlesticks or 10 candlesticks or 50 candlesticks. And each candlestick that we look at represents a week's worth of price action, right? And so as I'm looking at this SPX, we can see that my most recent candlestick, which is the one that we're currently in as of today, is green, meaning that we've gone up so far this week. Now, it's only Tuesday, the 26th of September. We've only had 1 day's worth of trading this week, so that meant yesterday the market went up. Last week was red, and it was a big red one, so last week the market went down. Matter of fact, the last 3 weeks have been red, so 3 down weeks in the market in a row. But what's my average price over the last 20 weeks? That's what the simple moving average is going to tell us. So when I go to adding my studies, I'm going to go to an S and I'm going to go to simple moving average. There's many studies that I can use, and a study doesn't tell me to get in and out, but it does help me to smooth price action. So my simple moving average. Now my default that shows up here is this little green line shows me the average closing price over the last 9 periods. So that average closing price that we see over the last 9 periods, if I edit that, I want to switch it to 20. And the reason I want to use 20 is because 20 is going to give me a little bit longer period to pay attention to. This is going to be my off switch. The 20 period simple moving average is my off switch. So very simply, when the market gets below the 20 period moving average, we are off. We are out of the market. So for those of you that have 401ks and you can only be in the market with your mutual funds when the market's going up, essentially when this happens is when it might make sense to look to go to cash, right? Or to find some alternative investments. But in this case, it's important and very timely because we just crossed below there last week. Last week's price action got us below that 20-week moving average. And so since we're below that price, that would tell us right now we should be out of the market. Historically, if I go back and look at this, and let's go back instead of looking at the last, let's look at the last, we've got 10 years worth of data on here. Let me zoom out a little bit. If all we do is look at that 20-week moving average, this would tell us we're in and then we're out, and then we're in and then we're out, and then we're in and then we're out, and then we're back in up above here. Well, if I use the 20-week moving average as a way to get in, what I wind up missing are a lot of big runs, right? These runs here can be very substantial to your portfolio. And so while I love the 20-week moving average as a time to get out of the market, and it allows me to pick up on some of these rather large runs by staying in an uptrending market for a very long period of time, I don't necessarily love the 20-period moving average as an on switch. I like it as an off switch because it allows me to be a little slower, but I don't like it as an on switch. So what's my on switch? My on switch is going to be an exponential moving average. So what is an exponential moving average? An exponential moving average is the same as a simple moving average in that it gives me the average closing price, but the difference is that there's a little bit more weight to the most recent price actions. So now I'm going to edit this one, and I use the 8-period exponential moving average, and I'm going to make this blue. So the 8-period exponential moving average is my on switch. The off switch always comes first. So right now the market has switched off. Well, when do we get back in? We get back in when price closes back above the 8. Well, we can see right now that our 8-period moving average is higher than current price. So we would still be out of the market. So if we were to extrapolate this out further and we were to imagine something like our 20-period moving average eventually looking more like this, and our 8-period moving average would continue to look like this. Let's just make it blue so it matches our color. Well, we would then wait for a candlestick, and let's say that next week we have a very, very, very weak market, and the market looks more like this, right? And then the following week, we get another down week in the market, right? And all of a sudden we've just seen the market give a very strong pullback. Well, what we're going to see in that case, is that our moving average is probably going to have come down more like this. Well, because the 8-period moving average is going to run a lot closer to price, that's going to mean that when we get another week where the market does something like this, now if we cross back up above that 8-period moving average, that would now give us a reason to get back into the market. Even though we're still going to be below the 20 at that point, getting above the 8 will allow me to get back into the market, right? And so then I will look and use the 8 as my on switch and the 20 as my off. Now, if we stay above the 8 and we continue to run higher and we get back up above the 20, we stay in the market until we cross below the 20. What happens if we get above the 8-period moving average, but we don't get back up above the 20? What I have seen is that historically, and looking back and doing some back testing, that doesn't often happen. Normally, when we get above the 8, we do eventually come back up above the 20 within 3 candles. If we're not back up above the 20 within 3 candles, you still want to be out of the market. So you give yourself 3 candles in order to get back out of the market to say, okay, it's not working. This allows me that time to evaluate the market. It's a slow enough system because it's a weekly time period that I don't have to overreact to every single market movement. When we look at how we manage funds and how we identify opportunities, that what we really have to first look at is what's the overall direction of the market, and this makes a great gauge. So hopefully that makes sense to everybody. If you have any questions, as always, shoot us an email, support@tradersarmy.com. Until the next market brief, I'll talk to you soon. See ya.